Currency ke skoloto. Now that might sound a little bit strange, but every rand that you have in your pockets was created because someone somewhere went into debt. And the biggest player in this whole system is not your bank. It is the bank that your bank banks with, the central bank. Mo Africa, this episode is brought to you by our sponsors Stokvel Gold. They assist us in all our silver and gold purchases. If you want to start your gold and silver journey, feel free to hit the link in the description below and Stokvel Gold will be at your service. Welcome to The Money Revolution, the podcast where we empower one another to build wealth through the sharing of information and ideas about how money really works. In today's episode, we are discussing the biggest player in the banking system, the central banks. I will once again be your handsome host, Masijela Waramantu. Let's get into it. A central bank is the authority that controls a nation's supply of money and credit. In South Africa, our central bank is called the South African Reserve Bank. It uses tools like open market operations, changes in reserve requirements, and credit lending to manage short-term interest rates and to manage the monetary base.
Is very technical.
It sounds technical, right? But it actually isn't. The central bank actually decides when, where, and how new money enters into the economy. That's it. There was a time in recorded history when central banks did not exist. This was the era of the gold standard. Back then, money was either in the form of gold or silver. And in order to get either gold or silver, governments had to mine it, which takes a significant amount of time as opposed to just printing it. Then came the Swedish Riksbank in 1668, the world's first central bank. How did this come about? Between 1658 and 1660, Denmark and Sweden were at war with each other. To pay for wartime supplies, the Swedish government started diluting the weight of its copper coins. What they did was that they produced more copper coins from the same amount of copper. And this caused the prices of goods and services to go up. And if you remember, back in episode 3, we referred to this as currency dilution. And what it does is that it creates inflation within an economy. As a solution, the Swedish elites proposed the formation of a central bank. A central bank that would be privately owned and make sure that the currency dilution never happened, particularly in times where the country is at war. Instead, the Riksbank would lend money to the government and the government would essentially pay it back through the collection of taxes from its citizens. Noble intentions, right? But also a very, very clear shift where now the control of money lay in the hands of private actors. The Bank of England in 1694 copied this very same model, lending to the government and holding deposits for these smaller banks, and essentially protecting coinage dilution. During any wars, the central bank would lend money to the state at agreed terms, and then the central bank became the financial foundation of nations today. The South African Reserve Bank says that its mission is to protect the value of the South African currency. Like the Riksbank, the South African Reserve Bank is privately owned. Also, like the old central banks, the South African Reserve Bank lends to the government, and this lending occurs in a process which we refer to as open market operations. Now, let's break this process down a little bit. Let's say the government needs money to build either a school, a hospital, or even public roads, or any other form of public service that we can think of. What the government would then do is that they would issue something we call a government bond. This is a promise to pay a fixed interest and to also repay the loan after a certain period of time. Normally, government bonds go over a period of 2 years, 5 years, some even over a 30-year period. Banks would then buy these government bonds, which simply means that they loan the government the money it needs to provide those social services. The Reserve Bank then comes in and buys these government bonds from the retail banks and essentially take over these loans. But the Reserve Bank also then lends back these loans back to the retail banks at a profit margin. The profit portion of this is called the repurchase rate or the repo rate. So when you hear that the repo rate has decreased, it simply means that the profit margin demanded by the reserve banks from the selling of these loans to retail banks has decreased. Let's say the government needs a 1,000 rands loan to refurbish Bree Street. Bank A goes in and gives the government 1,000 rands and say, please pay me back in 10 years. Then comes the Reserve Bank, which says to Bank A, I see that you are running a little bit low on your cash. So I'll give you 1,000 rands to take over that 1,000 rand loan that you have with the government. But in 2 weeks' time, you need to pay me back at 1,060 rand. That is 6% above the original amount, which is the repo rate. The Reserve Bank then goes and prints 1,000 rands at the South African Mint and deposits it into Bank A. This deposit is essentially how money enters into circulation. This process of central banks buying assets from retail banks and selling them back to banks is known as open market operations. After the 2008 global financial crisis, this whole game changed entirely as central banks now adopted a process we refer to as quantitative easing. Instead of working through retail banks, central banks can create unlimited money, literally with a few keystrokes. Former US Federal Reserve Chair Ben Bernanke once said on a 60-minute interview,
it's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
That we simply use computer to mark up the size of the account the bank has with the Feds. And that's it. Money created out of nothing. And remember, the stated goal of central banks was to protect the value of money. But when you create more currency, you weaken the currency. And just a quick question, does 1,000 rands today buy you the same amount of goods as it did back in 2010? So here's the truth. Central banks were designed to stabilize the currency. But today, their actions often do the exact opposite. By injecting trillions into the monetary system, they are quietly reducing your purchasing power. And let me tell you, Africa, it will end up the same way it has always done, in a currency collapse. Thank you for joining us on this fiery episode of The Money Revolution. If you found the ideas discussed in this episode insightful, hit the subscribe button below, share and like these episodes on The Money Revolution. And to get notified on our next uploads, please hit the notification bell below so that you don't miss out. Let's wake up the masses. Let's understand how money really works and take back our power one conversation at a time. And remember, if it's paper, it will perish.